You're doing everything right. You save every month, you avoid unnecessary debt, you budget, you track, you research before you buy. And yet, you're still stuck. Not broke, not reckless, not irresponsible, just stuck. And here's what nobody is telling you. The habits keeping you stuck are the exact same habits everyone told you were the right ones. In the next few minutes, I'm going to show you something that took me years to understand. There are 7 money habits that feel like financial wisdom, that look like financial wisdom, that every personal finance blog, every subreddit, every well-meaning family member will swear by. And quietly, invisibly, they are engineered to keep you exactly where you are. Not by accident, by design. We'll get to the most dangerous one at the end, because the last one is the one you'd never suspect. Let's start at the beginning. Here is how most Americans handle money. Paycheck arrives, rent, utilities, car payment, subscriptions, groceries, maybe a dinner out, maybe a small treat. And then whatever's left over gets saved. It feels responsible. It's not. The average American saves just 3.5% of their income, less than half the historical average. And the reason isn't laziness, it isn't stupidity. It's a sequence problem. When you save what's left, you're treating your future self like an afterthought, an optional line item, something you'll get to when you have more. But here's the thing about when you have more. That moment never comes, because expenses expand every single time. The fix is brutal in its simplicity. Automate your savings the moment your paycheck hits, before rent, before groceries, before anything. Even 5%, even 3%. The amount matters less than the order, because what you never see, you never spend. We have decided, as a society, that debt is normal. Not just normal, expected. We finance clothes, we finance vacations. We put groceries on credit cards with a 23% interest rate and call it cash flow management. Here's a number that should make you uncomfortable. $1.23 trillion. That is the total American credit card debt, right now, today. The average balance? $5,595 at 23% APR. If you carry that average balance, making only minimum payments, you will pay over $3,000 for things you already consumed. The rewards points don't cover that. The cash back don't cover that. Nothing covers that. Credit card companies are not in the business of helping you build wealth. They're in the business of making you feel like they are. Now, here's where it gets uncomfortable, because habits 3 and 4 are things that feel like safety. They feel like you're being smart, prepared, ahead of the curve, and they are slowly draining you. 43% of Americans cannot absorb a single $1,000 emergency from their savings. Not a catastrophe, not a medical crisis. $1,000. A car repair, a broken appliance, one bad month. And 24% have nothing saved at all. Think about what that means in practice, because it's not just stressful, it's expensive. When you have no emergency fund, every unexpected expense becomes debt. Debt becomes interest. Interest becomes months of digging out. The absence of a safety net isn't neutral. It actively costs you money. 6 months of living expenses. That's the number. Liquid, accessible, boring. That is your first real financial goal. Here's a question. Right now, without opening your bank app, can you tell me what you spent last month? Not roughly, exactly. Most people can't, and that matters more than almost anything else on this list. There's a pattern called lifestyle inflation, Every time your income rises, your spending rises slightly faster, silently, automatically, without a single conscious decision. You upgrade the apartment, you upgrade the car, you upgrade the groceries, the subscriptions, the vacations, and you're earning more than ever and saving the same percentage, which is to say, almost nothing. Pull up last month's bank statement, right now, tonight. Categorize every transaction. I'll tell you what you'll find. Between $200 and $300 a month, going to things you don't value, things you forgot you subscribed to, things you bought without thinking. $300 a month, that's $3,600 a year. That's real money. That's a Roth IRA contribution. That's your emergency fund. Okay, stop. Everything I've told you so far is about cutting, spending less, saving more, budgeting tighter. And it works, to a point. But here's what nobody puts in the finance videos. Saving has a floor. You can cut your coffee, you can cancel subscriptions, you can coupon and cash back and optimize every single dollar. And at some point, you run out of things to cut. Your income has no ceiling. Let me put it in numbers. If you save $100 more per month, that's $1,200 a year. If you increase your income by $500 per month, that's $6,000 a year. After taxes, still more than triple. The saving side has limits. The earning side is almost unlimited. Skills, promotions, side income, digital products, every one of these can scale. Coupons cannot. This isn't about abandoning financial discipline. It's about understanding which game actually changes your life. And right now, most people are obsessing over the smaller game. Taxes. Over your lifetime, taxes will likely be your single largest expense. Bigger than rent, bigger than your mortgage. And most people pay them without ever questioning whether they're paying more than they legally have to. Here's one number. A Roth IRA, maximized over a career, can end up hundreds of thousands of dollars ahead of the exact same investments in a regular taxable account. Same stocks, same returns, same discipline. The difference is purely the tax structure. That gap is money you could have kept, that instead disappeared, legally, silently, forever. You don't need to be wealthy to access these structures. Roth IRA, HSA, 401k match, these tools exist for everyone. Most people just never learned they were there. Here's the most painful math in personal finance. $10,000 invested today at a 7% average annual return becomes $76,000 in 30 years. Wait 5 years to start? $54,000. You lost $22,000 by waiting 5 years. 5 years you probably spent thinking you'd get to it eventually. Time in the market consistently, historically, mathematically beats timing the market. There is no perfect moment. There is only the moment you start. And the earlier that moment is, the less work your money has to do. Someone who invests $300 a month starting at 22 will retire with more money than someone who invests $600 a month starting at 32. Half the investment, more wealth. That is the cost of waiting. Remember what I said at the beginning. You're doing everything right, and you're still stuck. Here's the habit nobody names. The habit of believing that being responsible with money is the same thing as building wealth. They are not the same thing. Responsibility keeps you from falling. Wealth building makes you rise. Most people master the first one and mistake it for the second. They save the leftovers, they avoid the obvious debt, they think about cutting before they think about earning. They have the right instincts pointed in the wrong direction. The system doesn't punish irresponsibility alone, it punishes passivity. Paying yourself last is passive. Waiting to invest is passive. Ignoring your tax structure is passive. Optimizing your spending while ignoring your income is passive. Wealth is not built by people who avoid mistakes. It's built by people who play offense. And the good news? You already have the discipline. You already have the habits. You just need to redirect them. So here's what I want you to do this week. Pick one. Either set up an automatic transfer, any amount, the same day your paycheck lands, before anything else gets touched. Or open your last month's bank statement tonight. 30 minutes. Categorize everything. Find where your money actually went. Or look up what a Roth IRA contribution looks like for your income bracket. Just look it up. Understand what's available to you. One action, 1 week. Because the gap between knowing this and doing something about it is exactly where most people stay stuck. The habits you build this year will either compound into freedom or compound into more of the same. That's not dramatic, that's just math. In the next video, we're going to look at the specific moment most middle-class Americans lose the most money, not through bad decisions, through one very specific life event they never saw coming. You don't want to miss that one. See you there.